Good morning to one and all. This is Dr. P. Lavanya, working as Associate Professor in MBA Department in Institute of Aeronautical Engineering. Today we go regarding the question bank relating to the Module 1, relating to the Introduction to the Business Economics. So here we come across the questions like compare the differences between the marginalist and equi-marginalism. So first, when you have given these questions between the comparison or the differentiator between the two terms, first we should go regarding the definitions and meanings of the wording, then we should go for the differentiation. So here they have given the differentiations between the marginalist and equi-marginalism. So first we can say what is marginalism and equi-marginalism concepts and how that concepts are related to the economical decision making and also the resource allocation. So we have to identify the concepts and that relates to the decision making and allocation of the resources. So now we explore the differences between these marginalism and equi-marginalism. The first one is marginalism. So we define the marginalism as it's an economic theory that focuses on the analysis of decisions relating to the margin and incremental changes in the variable. Means here what type of margin means when we want to go for any sort of economical theory, we focus upon the analyzation of what margin we are getting and what type of incremental changes means the differentiated or additional changes we are able to get relating to the one variable. We'll conclude it as a marginalism. Means when some variable changes, what sort of margin will be left over for an economical person. So this marginalism will explains or examines the impact of one unit changes in a particular variable on overall decision making process. Means here the changes what we have taken relating to the variable means the incremental changes relating to the per unit. So what sort of impact will be there if one unit of variable is changed, which gives the overall impact upon the decision making. So for this marginalism, we can give a definition that production in the context of production as the marginal cost means it is called as an additional cost which is incurred by producing one or more unit of goods. Means we can give the example of marginalism concept which was used in the different economic theory is the marginal cost or call it as a variable cost which is quantified relating to the cost per made for one unit of goods and services to be produced. Now we go relating to the equi-marginalism. So first we'll see the concept of equi-marginalism. Equi-marginalism is an extension of marginalism that emphasizes the equality of marginal utility or cost. Means this marginalism is extension, that is equi-marginal utility is an extension to the marginalism. Means what additional benefits does an organization or an economical person will get, it gives more emphasis relating to that additional benefits relating to the equality of margins which will be used for utilities or cost across the different activities of the goods. Means the additional benefit what we earn that should be equalized between the cost and the revenue will gives as an equi-marginalism. So these concepts suggest that we require the rational decision making in case of allocation of resources in that the marginal utility or the satisfaction what we are getting that our marginal cost will equal to all possible uses. Means in case of equi-marginal utility we has to equalize the cost and also the benefit what we are getting. So a rational decision maker he want to get a maximum satisfaction by additional marginal cost within a marginal revenue. So the example for equi-marginal utility where we can say that a certain amount of money we can spend on deriving a satisfaction relating to the two items. Maybe we'll take like relating to the food items where a person want to spend upon a consuming of both pizza and ice cream. So here the equi-marginal utility suggests that every individual should utilize or spend or allocate the money in such a way that individual will get maximum satisfaction in spending the money upon both the goods. Means we should spend in such a way that the individual will get a good satisfaction or the maximum or equalized satisfaction by spending some amount upon one product, maybe we'll call like pizza, and some amount upon the ice cream. So here these are the two types of the concepts which we can evaluate relating to the marginalism and equi-marginalism. Then the differentiation item will have to go relating to the focus. So these two concepts will focus upon. The first one is marginalism. So what is the focus of marginalism? Means it have the focus only upon the incremental changes in a single variable, where we can say like in the production, consumption or the distribution network, the marginalism will focus only on the change or additional change in a one variable. We'll consider it as a single variable. But when you come across this equi-marginalism, the focus will be analyzed in allocation of resources among different types of alternatives, which ensures equality in marginal utility or cost. Means here in the equi-marginal utility, we doesn't focus on a single article or the single variable. So we utilized or we want to go for allocation of the resources to different alternatives such that the spending of the cost or the marginal utility will have the equality between different types of alternatives. Next item is decision making. So in case of decision making, we comes across that marginalism, it analyzes the decision make upon the impact of decision will be there only upon the change of a single or one variable. Means the decision will analyzing that, saying that what type of change was taken place relating to the one variable which has been changed due to the additional impact of cost or revenue. But when you comes under the equi-marginalism, here it guides the decision making relating to the, as we know, it is optimum or maximum allocation of the resources to the different alternatives or activities, such that it will use the overall or maximum satisfaction of an individual while taking the decision. Means the decision will be taken in an overall sense by examining the different types of alternatives, such that the satisfaction will be minimum by overall decreasing of the cost, and the satisfaction or marginalism will be maximum. And next differentiation we can say in case of optimization. So in case of optimization, marginalism deals with optimization of relating to the specific activity or one variable. Means here the marginalism focus its optimizing of resources related to the only one type of variables or the one type of utilities. But when you comes under the equi-marginalism, it aims in allocation of the resources among the different activities which achieves the equilibrium in marginal utility or cost. Means the optimization will become here relating to the different types of alternatives. By enhancing these alternatives, we can achieve maximum equilibrium between the different alternatives in allocation of the resources, and also getting the maximum satisfaction by minimization of the cost. So by this above items, we can say that we can contrast between the marginalism and equi-marginalism, where here the marginalism totally focus upon analyzing the decisions relating to the in specific variables or only one variables. Means each and everywhere marginalism comes with getting the decision making point relating to the only one variable. But at the same way, equi-marginalism, it is an extended, means it was adding marginalism along with specific focus upon one variable, it will add many other alternatives in case of decision making. So these equimarginalism will goes on optimum utilization of the resources where they are utilized in the different alternative decision making, and such that these optimization of the resources in different alternatives will ensure the equal distribution of marginalism, where we can say minimization of the cost and maximum satisfaction or the utility will be derived. So by contrasting of these two concept of marginalism and equimarginalism, where we can say that marginalism is in a limited scope, but when you comes under the equimarginalism, it is having a broader applications and principles of marginal analysis is widely used. So this is the answering for the question relating to the differentiation between the marginalism and equimarginalism. Next, we come across the another question that demonstrate the macroeconomic features in the managerial economics. So for that we give first the introduction of macroeconomics, and at the same way what are the features which have impact upon the managerial economics, means business or decision making economics, means how these features will shows its impact upon those decision making economics. So first we can say that as we know, this managerial economics means itself involves in the application of economic principles and concept to the managerial decision making, and these macro features plays a crucial role in shaping the business environment, and also it will helps in influencing the decisions made by the managers. Means the macroeconomics is a wider concept, as we know all the environmental, means internal factors and also the external factors where the business will operate, means totally it will take into the all economic environmental factors which will shape and influence the decisions what a manager will be take. So in case of this macroeconomics, there are some key features which gives a more impact upon the managerial economics. So the key features are, the first one we'll call it as GDP, which means gross domestic product. So as we know, this GDP is one of the important economic factors which will influence the economic growth of the each and every country. So what sort of impact will be there upon these macro feature is, often the managers want to consider the overall economic inputs. Often the managers want to consider the overall economic inputs relating to the GDP. So here the overall economic output of the country like GDP, where it make decisions about the production levels, market expansion and investment. Means our country's economic growth will be influenced by some sort of factors like overall production of the country relating to the goods and services, and market expansion, what sort of national and international expanding of the markets will be there, and investment in national or maybe the international like MNCs, multinational organization. So by influencing these GDP trends or the changes, the macroeconomic will be changes and plays a crucial role in economic development of the country. Next, inflation. So normally we'll call inflation means rising prices. So the impact of inflation relating to the rising prices in case of decision making is, as the rising prices will affect the cost of a production, and if the cost of production increases, as we know the prices will also increases and impact upon the pricing strategies and consumer, which gives a later impact upon the consumer purchasing power. So these inflation can be a very important variable which will influence relating to the allocation of the state's resources and also related to the inventory management of each and every organization. once the total cost increases, the internal aspects of the allocation of the resources will be limited, and here the inventory management should be taken in a very cautious manner in order to detect the economical progress of the country. So, the inflation is one of the important aspect relating to the macroeconomic feature in the decision making. Next, unemployment. So, the factor of unemployment is a crucial problem that each and every developing nations was facing. So, as the population increases and the government or the people unable to get an employment through the resources utilization. So, here what sort of impact will be there upon the managerial decision making relating to this unemployment. So, high unemployment rate in any country may result in reduction of consumer spending and impact upon the demand of goods and services. If unemployment is prevails more, the purchasing power of the consumers will be less, such that consumer will spend very less amount in case of goods and services. So, the organization or managers has to take into the control relating to the employment situation of every organization, where it is in a macro factor which help the every organizations relating to the planning of production levels, staffing, and also the marketing strategies. So, based upon the country's employment nature, the company has to give its strategies relating to the marketing or relating to the what sort of production to be evolved or planning of the production, and related to the employment, that is staffing of the people, is have been a lot of impact relating to this unemployment. Next, interest rates. So, the interest rates which are offered by the bank, which will influences in case of the capital decision of each and every organization, and widely the developing nations always faces a problem relating to the procurement of this capital. So, there is a lot of impact upon the decision making relating to the interest rates, where we can see these rates means the influence of these interest rates will have a wider impact upon cost of borrowing, and which affects the investment decision and capital budgeting of an organization. Means if the interest rates are high, then internal cost of the capital will also be high, as the procurement of the resources are high. And if rates are less provided by the government and procurement of the capital will be at a cheaper rate, so the high or the lower interest rate will influences the investment decision of the organization and long-term capital requirements, which we'll call it as capital budgeting, is also influences in a wider manner. Next, the government policies. So, here the impact of managerial decisions will be depends upon the changing of government policies, may be relating to the budgeting or any other rules, regulations, or the conditions levied upon the business environment. Here, the change in the government spending taxations may be related to the taxation policies or other budgeting or fiscal policies will aggregately affect the demand and supply of overall economic activities. Means, as we know that once the government changes its policies, then it is largely affects the spending activities of each and every organization. Maybe it is of taxation or maybe budgeting and other physical policies, or maybe related to the overall aggregate demand, which will influences the economic activity in a wider manner. So, here we can say that always the managers must and should be aware of the government policies in order to implement their changes, which may relate or which may use more impact upon their industry, tax incentives, subsidiaries, or regulatory changes. Means the organization must and should be in a mood in order to understand the government policies or the changed policies, and they has to be incorporate those changed policies, subsidiaries, or regulatory changes in order to go with the external environment. Next, exchanging rate. So, the exchanging rates influences a more which have related to the currency at international rate. Means as the boundaries changes, the currency will also, rate will also changes based upon the GDP of an economic, GDP and economic development of the country. So relating to this currency differentiation of different nations, the companies are engaged in international trade and exchange rate placed at a significant role. Means the international trade, that is BOP, balance of payment at an international level, is totally depends upon the exchange rates of an at international level. So the international rate plays a significant role based upon these currency rates. Here the managers of the internal organizations has to monitor and manage their currency risks, considering the impact of cost of inputs, pricing strategies and competitiveness in the global markets. Means the managers has to must and should have the monitorization relating to the risk which involve in the currency rates. While considering the risk of these currency rates, we has to identify there what sort of impact will be there upon the cost of the production inputs and pricing strategies and competitiveness at international or global level. Next, global economic conditions. So as we has to consider the business or the macro environment itself incorporating not only a fixed environment, we is to expose ourselves to the external international environment. So the multinational organization has to function in the global economic conditions. So when we have to see a larger impact for these MNCs in case of managerial decisions relating to the changing of global economic conditions. So we have to take in the trends or the changing aspects of international global economies. So the economic events which has been taken place in the different nations may be relating to the affecting the demand and supply, or maybe the supply chain management or demand of a production or overall competitive landscape. Means international trends or the changes takes place at a global level should be identified and that changes to be incorporated while taking the decisions at a global level. So when it comes for the technology, so as we know the innovation and technology are the major changing part and parcel at a national or maybe an international level. So overall it is having a very good impact upon the managerial decision making, where the advances in the technology will impact in case of production process, marketing dynamics and consumer preferences. Means relating to the any sort of changes made in the production or marketing differentiations or consumer taste and preferences, the technological advances has to be identified. So the managers must and should stay carefully observing the changing technological development. So this should be informed in case of informed decisions. Once the technology has been changes regarding to the any aspects of the production, it should be observed or provided to the each and every managers or the workers notification, such that it will affect regarding the investment, and the new technology will also adopting at a changing marketing trends. Means external marketing trends could be changed based upon these changes in the technology at or adopting the advanced technological features. So by taking the above analysis, we can say these are the some of the broad macroeconomic features maybe which are incorporated and helps the managers in case of decision making process. So the strategies or the decisions must be at a more informed in order to choose these macroeconomic features affect in a broader economic environment. And it will also helps the negating of the risk, means minimization of the risk and identifying the external opportunities and ensuring them in a long-term stability of the businesses. So in this way, these macroeconomic features will be very much helpful or having a broader impact in case of managerial decision making of in every organization. The next question. Formulate an example to analyze the risk and uncertainty. So here when you have been taken a normal question or a quite exemplary question asking that what do you mean by this risk and uncertainty, and how do you take some example and hypothetically explain how it will affect the organization. So first we'll consider relating to an example of organization which itself has been involved in case of technology startup that is in development of any new product. So an advanced artificial intelligence, that is AI system for predicting the stock market trends. So we'll take an hypothetical example relating to the artificial intelligences which has been a system introduced in order to identify what are the changes or the predicting the changes takes place in the stock marketing trends. So the success of this product means the prediction of the stock market trends will be depends upon the several factors that a company is facing related to the both the risk and uncertainty throughout the development of the product and also the launch of the new product into the market. Means hypothetically we'll exemplary explain that how that AI system is developed for a new product in predicting the stock exchange will expose itself in facing this risk and uncertainty. So first we'll see the scenario of market risk. So the risk scenario in case of stock market, as we have been inherently, it is an unpredictable one, and the success of this artificial intelligence system relates that accurately forecasting the market trends. Means as we know that stock market always having its ups and downs where we cannot 100% predict what will happen. So unpredictedness is a common feature of the stock market. So the success of this new development of AI takes place accurately based upon the forecasting methods or the techniques. So if market behaves unexpected by unforeseen economic events or geographical factors, then the product may not perform as expected. Means if the forecasting of these market doesn't behave, means unexpected things happen or maybe geographically some forecasted seen things happen, then automatically we can say that product cannot perform what we have been expected. So here we can predict up to some level in case of risk scenario. But when you comes in the uncertainty scenario, where it is in a dynamic and nature of financial market introducing the uncertainty, means the future behavior of that stock, the predicting market trends with certainty is a challenge due to constantly changing the variables. Means as uncertainty is the future expecting what will happen relating to the stock trends, but which is a very unpredictable. Why? Because in the stock market the variables or the factors will constantly change. Next, then we come across the technological risk. So in case of technological risk, as we know that new developments or the new technological advances are constantly attacking the market in the competitive scenario. So when you develop this AI system which involves in cutting an edge in the technology, where we can say that technological challenges will arise leading to the delay or performance issues. Means due to these technological changes or the challenges, the AI system cannot operate in a competitive environment according to our expectation. Here the delays or performance issues may be considered. Maybe for example when you take an algorithm which may struggle to add a new market pattern leading to the inaccurate predictions. So means we can say that when you take some algorithm which may use us relating to the adopting the market pattern, market issues, which may relate it to the inaccurate predictions. Uncertainty. The next, the fast means the technological changes, where we can say that it is a fast phased where the development of technological advances prediction becomes very difficult. Where when you introduce this uncertainty about the effectiveness and the reliability of artificial intelligence system, the unforeseen breakdowns or setbacks in the AI research gives a broader impact upon the product success. Means as we have set it some sort of technological advances which may not be considered in the real world or the real thing, which may affected by unforeseen issues, then automatically the impact upon that product will affect the success of the development of this new product. Next, regulatory and compliances risk. So in case of this regulatory and compliance risk, the financial industries will have heavy regulatory framework, and the change in this regulatory framework is an unexpected challenge and which gives an impact upon the product compliances. Why? Because the government rules regulations will be goes on changing. Once it changes, it will give a broader impact upon the risk to the product compliances scenario. But when you comes under the uncertainty point of view, where this evolution of regulatory framework, where it introduces the uncertainty that how that laws and the policies regarding AI financial may change its over time. Means as the risk associated with new changes in the regulatory, but uncertainty how far that could be worked in the present environment or the present financial AI system over a time period. Means uncertainty where we should wait and identify the policies how far it was affecting the economical resources. Next, competitive landscape. So in case of the competitive is an inevitable feature in every business organization. When you comes under the competitive landscape, risk is involved that many companies developed, maybe if same AI system, artificial system has been developed relating to the product, which they will increase the competition between the different companies. So if the competitor has been released more accurate and more cost effective solution, then it will affect the market and share and success of the startup product. Means though the 2 or 3 companies or the many companies came with the same sort of AI product, so the competitors when it having more accuracy and cost effectiveness, all will share. Means the companies all will affect the market share and the success of this startup products will be taken to some consideration manner. But when you comes in case of uncertainty, the action and the strategies of the competitors are uncertain. Means as the competitors follows the same type of AI, but how they want to influence is in a different. Means as we don't know how the competitor is using that technique, and it is very difficult to predict the move of these evolving AI in the marketing introduction, as it is in a competitor's dependency nature. So where it is a highly unpredictability. Means in case of uncertainty, we can't predict how the competitor will use. So relating to the customer adaptation and perception. So the risk scenario in case of when you have been evolved or given a new AI product in case of stock market, predicting the stock market trends. So how far the customer will adopt or maybe perceive this new system, it relies upon the adaptiveness of the customers. If the potential issues or users will typically about the AI stock market prediction, then the negative public perception of the technology, which may hinders the adaptation of new technology. Means when the consumers are willing to accept, it gives in a positive adapting scenario. But once this AI system has been negatively impacted upon the consumer's perception, then it is very difficult for the company or the organization to take a part of this AI system. But when you comes under this uncertainty, the public perception relating to the AI financial market is uncertain. Means how far the public will receive in a positive manner, we can't predict. And at the same way, the startup, that is new ventures, faces challenges or some critical problems relating to the convincing the potential users about the reliability and benefit of the product. Means as we know how far the positively taken by the public, and which creates a challenge, and organization has to go for a greater convenience, conveniencing nature relating to the potential users about their adaptability of this and the benefits relating to the product by using this AI system. So in this way, we can give an example relating that how these risk and uncertainty will crucially shape a startup company relating to the mitigating the strategies and make informed decisions in development and also launching of new type of AI system. So this is one type of example where we can analyze or expose the differentiation or a product impact relating to the risk and uncertainty. Next one, analyze the different features of managerial economics. So the managerial economics, it is a branch of economics where we have an applied economic theories, principles which make us to solve the business problems. So these managerial economics focus mainly upon the decision making relate to the firm or organization in achieving its goals and to perform in an effective manner. So here are the some of the key economic features of this business or managerial economics. The first feature is microeconomic foundation. As one of the important key feature of this business economics relating to the decision making is microeconomics. Micro means small, related to the individual firm or the individual organization. So here the business economics itself rooted in micro in nature, where it will deals relating to the behavior of individual economic agents such as the firms, consumers and also the resource owners. So it analyzes that how these entities make decisions in allocation of resources. Means what type of the microeconomics or individual firm will act. By analyzing these, the consumer, firms or research owners and utilizing these entities in case of decision making. Next one, decision making oriented. As we said that economic nature itself, that is micro itself related to the single firm which related to the decision making. So its primary focus upon the managerial decision relating to the managers, how they use the economic principles and to make the informed decisions relating to the production or pricing, resource allocation and other aspects of business operations. Means the one of the important feature of this managerial economics means how a manager will differentiately take a decision and inform those decision to its required people. Maybe it's related to the production pattern or maybe the resource allocation or the other aspects of the business operations. Applied in nature. Another feature of this managerial economics was it is in applied in nature, as it is a practical applications and which we can use these the features of managerial economics to solve the day-to-day problems. So it takes into the consideration like economic theories and applying those theories in the real world of business situation. Means the problems what we faced in the organization will be solved by these managerial theories. So it is applied or practical in nature due to the solution of getting solution for day-to-day problems. The goals of the organization which we has to take in actionable insight of the managers and make them to take a betterable decisions. Means So where the manager can take a practical actions and conforms or impacts a better or good decisions in order to reach the organizational goals. Interdisciplinary approach. So this another important feature of this managerial economics means it is having interdisciplinary, means it is not related to the one practical thing. Maybe it is having many types of concepts and the tools related to the different subjects or different strategies. Maybe like this managerial economics or the business economics itself has been taken apart from the traditional economics and taken some logical relating to the mathematics, statistical tools and techniques and operational research. Means 3 to 4 subjects has been conceptually mixed and consider it as an interdisciplinary approach where it allows the managers to analyze the complex decisions and to solve the different issues in a comprehensive manner. And the next one, another important feature is optimization, where in case of managerial economics, it involves in optimization on where manager seeks to maximize his profits and minimize the cost to achieve the specific objectives. Means optimum utilization of the resources. By utilization of this optimum resources, the manager will get maximizing its revenue or benefits and minimization of the cost in order to achieve the goals or the specific objectives of the organization. And this involves in weighting the trade-off and make the choices that helps in the best outcomes of is another important feature of this managerial economics. Next one, marginal analysis. As we know, this marginal analysis itself involves in examining the additional or incremental change relating to the cost and benefits. So it helps us to identify what sort of margin is achieved by an economics or an organization by additional cost or additional benefit. So it is considered as a fundamental factors which has to be made the managers take the decisions related to the additional cost or the additional revenue which are associated with each other choices. Next, market structures and pricing. So these economics address the issues which relates to the market structures related to the competition and pricing strategies, where we have the perfect or imperfect market structures and the competitiveness determines the nature of the markets. So this helps the managers by understanding these market structures, pricing strategies and also the competition, where the managers have take the consideration of marketing conditions affects the pricing decisions of the firm. So another feature is the demand and supply, which is another important influencing factor of managerial economics, where it depends upon the market relating to the influencing factors of demand and supply. So which is very much important for every organization in case of decision making. So where the managers use the concepts of elasticity, that is the change, responsiveness of the change in one article to the another related to the price or other variables which affects the quantity, demand and also the supply. Risk and uncertainty. These are the common features in every organization where we should recognize the presence of its risk and uncertainty in the decision making. And this risk and uncertainty is a powerful tool for the managers in order to analyzing how to manage the different types of risk, that is internal and external risk, which included in the decisions relating the conditions of future uncertainty. Then time element, it is also one of the crucial factor of this managerial economics, as the time is a considered factor and time perspective to be identified in case of the timing of decisions may be related to the investments and return. So these concepts of the time related to the time preference of the money, which we'll call is famously value of the money, is applied and evaluated at present and future in order to identify the cost and the benefits. Means present value of the money is one of the important techniques which is considering the time element, helpful in taking the long term and the short term decisions of an organization. Next, policy implications. So this managerial economics is having the implication of government policies, rules, regulations, helps to analyze the impact of these regulatory changes, business operations, which assist us to formulate the policies promoting the economic efficiency. So by taking the overall above factors or the features into the consideration, so the economics is depends upon the practical decision making, and it focuses the approach related to the applied microeconomic principles, which helps the managers to take the informed choices relating to the dynamic and uncertainty internal and external business economics. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.